A very warm good afternoon to everyone. I hope all of you are doing good. I welcome you all back to today's session. As you know, this is your class number 4 of this ongoing prelims crash course, specifically class number 4 for economics. As you know, in the past few days, we have been discussing the most important current affairs from economics, especially keeping in mind the upcoming prelims examination in the month of May. So all those who have been preparing this year round for the toughest examination in the country, that will be on the 25th of May, I hope you have been very attentive in these classes and regularly have been watching and attending all the questions that we discuss here. My name is Harshmeet Singh and I am in front of you on behalf of the Narayana IAS Academy. Over here, we also offer you multiple courses so that we can make sure that you can realize your dream of becoming an IAS officer. We offer multiple courses. For example, there is a 1-year and a 2-year integrated course depending upon what is your target year for the UPSC exam. In this course, we will be covering your entire syllabus for the prelims examination, for the mains examination, with a lot of attention on answer writing, prelims practice questions and a lot more. We will also be making sure that you get a tailor-made structure for your preparation so that you don't have to go anywhere else for any other sources that you would need for your preparation. If you need any other information about our courses and the way in which we can help you out, feel free to check out the description of the video where you will find a link and you can get all the information from there. Again, we are here to help you in every step of the way when you go and try and achieve your UPSC dream. With that said, let's begin the session for the day. This is your class number 4 for economics. I really hope that if you are new here, you have already watched the first 3 classes. If not, please go ahead and see those classes as well. Class number 4 begins with another extremely important topic that has a probability of being asked by the UPSC. This is the rupee-dollar exchange rate. In the past few months, or rather in the past few years, we have seen a consistent depreciation of rupee, meaning that the rupee has become weaker. Or in simpler terms, how much rupee do you have to spend to buy a dollar? That amount is increasing. If you go back a few years, for example, you could buy $1 by spending about 65 rupees or 60 rupees in certain cases. Now, we are in a situation where in order to buy $1, you might need to spend upward of 85 rupees. That means the rupee's value is appreciating. Now, what is the perfect level of rupee as compared to dollar? There is no perfect answer to that. Countries around the world try to stabilize their currency, and it can work both ways. If your currency is too strong, that means if you have to spend much lesser rupees for buying a dollar, that means your commodities that you export will not be that attractive. Because someone sitting in the US, when they have to buy an Indian product, they will have to spend a lot more money. On the other hand, when your rupee becomes too weak, your exports will become attractive, but your imports will become much more costlier. So there has to be a balance struck in between the two. And this is where the RBI plays an important role. And the government of India also tries to stabilize this particular situation. In this article, we will be discussing about what exactly are the factors that impact the value of rupee as compared to dollar. What is it that the RBI does, or what is it that the government of India does in order to control the situation? And again, please understand, I'll repeat once again, the objective of RBI or the government is never to bring rupee at a certain level. The aim is not that, oh, rupee should be 60 rupees per dollar or 80 rupees per dollar. No. The aim is just to reduce volatility, because that is not good for an economy. You can't have a situation where today the rupee is, let's say, 80 rupees a dollar, tomorrow it's 90, then it's 70, because this volatility does not augur well for the economy. It does not allow the investors or the businesses to make a long-term plan. So the idea of the government or the RBI is mainly to reduce volatility, and they are not aiming for one specific level of rupee. Having said that, at present, the situation that we have here right now is that rupee has reached or breached the mark of 85. That is, you have to spend over 85 rupees to get a dollar. In India, very often, you associate this issue with the idea of national pride. That means, in case a rupee is depreciating, people usually associate it with the fact that India's prestige at the international level is declining. That is not true. Depreciation of rupee, in fact, would work in favor of exporters from India. Imagine this situation, and it's a very simple argument to understand. For example, there is a situation where $1 is equal to 60 rupees, and there is a situation where $1 is equal to 85 rupees. Now imagine someone is sitting in the US who wants to buy Indian products. If a person sitting in the US wants to buy Indian products, in this scenario, when he spends $1, he can only buy Indian products worth 60 rupees because $1 is equal to 60 rupees. But in this scenario, if the guy spends $1, he would be able to buy products worth 85 rupees. So for the person sitting in the US, what situation would he prefer? He would prefer this situation. So this is better for our exporters. So there is no point of associating the value of your currency with your national pride because it works both ways. It can be good for importers, it can be good for exporters, depending upon a case-to-case basis. Now, there are different ways in which countries around the world decide the value of their currency. India has a different kind of a system. Some other countries may follow a different kind of a system. For example, do you know after independence, for a very, very long time, the government of India fixed the exchange rate for rupee. It was the government of India that decided that, oh, we will decide $1 is equal to how much. And that went on for a long time till 1970s. After that, when the government realized the fact that this is not a good method, because see, when the government intervenes and the government says, I will decide the value of my own currency, that means the foreign investors, other countries, they will not trust you. Because who knows what the government thinks tomorrow? Tomorrow the government may reduce the rate or may increase the rate. So there is no certainty involved here. And this is a situation where the government should not get involved. Now at present, there are three ways mainly in which the countries decide their exchange rate. The most common one is called as a floating currency regime. The floating currency regime, as the name suggests, the government will not interfere in any way. They will let the market decide. The market will determine what is the value of their currency without any interference from the side of the government. This usually is seen in developed countries and developed economies, US, a lot of Western European countries, most European countries rather, follow this kind of a system where there is no checks and balances from the side of the government. The government just lets the market decide on the basis of supply of currency. The market will decide what exactly will be the rate. So that is an ideal floating rate situation or floating exchange rate situation. The second situation that we have, the second kind of method that the nations use to ascertain the value of their currency is called as the managed floating one. This is something that we see in India as well. Now, what it means is, in usual cases, the government will just let the market decide. Let the market decide what will be the acceptable rate of exchanging dollar. However, if it is going beyond a certain level, the government or the Reserve Bank may try to intervene. So they may try to intervene. Now, when the intervention happens, it is not happening by force. There are methods through which, and I will discuss that, there are methods through which they can ascertain the rate at which the value of the currency will be exchanged, but it is not a forced intervention. This is just trying and giving a nudge. Let's take a simple example of how exactly does it happen. In basic terms, to understand how is it that rupee and dollar value is decided in India. Let's understand this in very, very, very basic terms. The simple idea is $1 equal to how much rupees will be determined mainly by how many dollars are present in the Indian market. So the amount of dollars that are in India will mainly determine what exactly is the exchange rate. It's simple economics. When something is in larger supply, when there is a lot of supply, there is, for example, you might see at times there are certain vegetables that are sold at a very, very low price in some part of the year. There is a time period, there is a season when, for example, the tomato prices will crash, or when the potato prices will crash, they will reduce drastically. The reason being that there is a bumper production, they have produced too much, and when there is too much production, too much availability, and the demand is not that high, the prices will automatically reduce. Exactly the same thing happens in case of currency as well. When there is a lot of supply of dollar in the market, when the dollar is flowing freely in the Indian market, the value of dollar will come down, means it will be easier to buy dollar. So rupee will strengthen. And then the opposite is also true. When you have lack of dollars or you have very few dollars in the Indian market, means it will be difficult for anyone to buy a dollar. So the rupee will start to depreciate because you will have to spend much more rupees to buy $1. That's a simple argument. If you understand this background, that is how the currency is decided or how the value is decided, you will be able to understand what RBI does or what the government does. For example, let's talk about RBI because that is the primary body that tries to maintain or stabilize a level of currency. Now, RBI on a weekly basis, on a week by week basis on their website, publishes the data about foreign exchange or forex as they call it. RBI maintains forex reserve. So RBI, for example, maintains a lot of dollars with them. And this keeps on changing on a week to week basis. They publish those numbers. So for example, let's assume, let's take an assumption here that RBI right now, let's say, has about $650 billion. When they think that the rupee is going down drastically or when they think that the rupee is depreciating too much, and they would want to stabilize the rupee or they would want to empower the rupee or support the rupee, what should they do? They should increase the supply of dollar in the market. So you would see very often that when the rupee is depreciating at a very fast pace, the RBI starts selling some of these dollars. And the foreign exchange of RBI reduces. You can see that on a week to week basis when they publish the data. That when there is a slide in the value of the rupee, when there is depreciation of the currency, you will see the RBI selling more dollars in the market to strengthen the rupee. And then the opposite is also true. When they want the rupee to get slightly depreciated, what would they do? They would try and buy dollars back from the market so that again the dollar value increases or the dollar gets strengthened. That is how it works. So the single biggest factor is how much dollars or how much foreign currency you have in the country. Now, how does a country get dollar? Let's say for India's situation here, we can't print dollars, we can only print our own currency. So how is it that we can get more dollars into our market? There are various ways in which a country can earn foreign exchange. One, if you're a country like China, for example, that exports a lot of stuff. So if you are a heavy exporting country like Saudi Arabia, UAE, they export crude oil, China exports a lot of manufactured goods, France, Russia, they export a lot of weapons. So if you export a lot of stuff, you can tell your buyers that I will only accept payment in dollars. That is one way of getting more dollars in the country. That is, you export a lot. India, as you know, does not export a lot of commodities. That is a big issue. So that is one way. Second, when you get remittances, means people of your origin or your country, that is Indian diaspora living outside, working outside, when they send the dollars back for their family, for their friends, that is the second way in which you can earn foreign exchange. So first, if you are a majorly exporting country. Second, when you have remittances. Third, when you have investment coming in. If you remember, yesterday we had a detailed discussion about FDI and FPI. Both of these are methods through which foreign investors can bring their capital into India. So if foreign investors bring their capital into India, be it the stock market, be it investments in the companies, that also is a way for the government to earn foreign exchange or the country to get more dollars. Then there are also ways in which you can take a loan, which is obviously not preferable. These are certain ways in which you can get more dollars or more foreign exchange in your country. And why is it required? Why should you have foreign exchange in the country? Number one, it stabilizes your currency. It does not let your currency depreciate quite a lot. And second, and more importantly, when you have to buy stuff, when India, for example, has to buy oil, we also have to pay in foreign currency because the countries won't accept our currency, the Indian rupee, because Indian rupee is not that well globally accepted right now. So by all accounts, by all measures, it is extremely important for a country to have as much foreign exchange as they can, because it allows them to stabilize their currency. So we were discussing the first method that the countries use for determining the value of their currency is a floating method. That is, the governments just don't interfere. Second is a managed floating exchange rate system, where the countries or the governments do slightly intervene. They push or they give a nudge to the currency because they want the fluctuations. They want that the up and down nature of the currency should go away. They want a certain kind of a stability in the system. So this is the second one. Third, which is not used by most countries now, is something called as the pegged or crawling peg system. In this, what you do is you basically fix the currency value against a bigger currency. That means, for example, the country with which you have a lot more trade, the country with which you have a lot of diplomatic relation, or if most of your trade or investment happens from one major country only, you peg your currency against that. And the government basically has a bigger role to play. They will be the one who will determine the rate. If the value of dollar, for example, increases in some other market, this currency will also increase. So it is proportional to what happens to a major currency. Like in case of Hong Kong basically has pegged its currency against the Chinese currency. So it depends on whether you have a situation where one specific country is your major partner. That is a system that is seen in this particular case, where you peg your currency against some other currency in the long run. Now, apart from this, how is it that the currency valuation is decided? These were the exchange rates that we discussed. Apart from that, there are some other methods as well, using which you determine what is the value of your currency. Like the most common way in which we talk about currency and exchange rate is what we call as a nominal exchange rate. We were just discussing that $1 is equal to 85 rupees. That means if you have a $1 note, you go to an exchange authority, you go to an exchange system, you give it to them, they would give you 85 rupees or nearby that, cutting their commissions, etc. But that is what you expect. That is called as nominal exchange rate. You give one currency and you basically take the other currency back from them, equivalent of that value. That is the most commonly used thing. But this is not the only way in which you can see and understand the currency rate. One other way in which it works is called purchasing power parity, PPP exchange rate. Now, what is PPP exchange rate? See, very often when someone, let's say from India, goes to the US for a job, and let's say they tell you their salary. Let's say someone in the US says, oh, I will be earning $5,000 per month. Now, your mind calculates that, oh, $5,000 per month means, let's assume that dollar is equivalent to, let's say, 80 rupees. So your calculation goes that, oh, you'll be earning $5,000 per month means you are earning 4 lakh rupees per month. And then you think, oh, it's such an amazing job because 4 lakh rupees per month is such a huge amount. But what you're not understanding is that the $5,000 that the person earns in the US has a different value as compared to 4 lakh rupees in India. Why is it different? It's different because when you are in the US, you would have to spend in dollar only. So the commodities that you are buying there are not the same value as in India. For example, in India, you go to, let's say, a tea brand where you want to have some tea outside. You can spend 80 rupees, for example, to get a tea. Much less than that, but let's say the hi-fi places, you go, give them 80 rupees and they will give you a cup of tea. In the US, 80 rupees means $1. You might not be able to buy that tea for $1. The same tea, when it is being sold in the US, may cost you $2 or $3. So exchange rate doesn't really work like that. The nominal exchange rate that we discussed doesn't really work like that, because commodities, the same commodities, will have a different cost in different parts of the world. That is why it's not good to compare like this, that, oh, you're earning this much money in the US, let me compare it to rupees, because that is not how it works. For example, the rent that you pay here is not the same rental that you will pay in the US. And this is where the purchasing power parity system comes into picture. PPP. PPP, or the purchasing power parity system, takes into account that how much stuff can you purchase with that amount in the US, compare that to how much stuff could you purchase with that amount in India. These are not the same. If in India you can buy 100 things for 4 lakh rupees, you might not be able to buy all the 100 things in the US for $5,000. The value of the currency might seem to be the same, but they can't buy the same stuff because the purchasing power parity is different. So this is one more method of discussing or determining how much your currency is valued and what you can buy with that particular currency. Then there is something called real exchange rate. Real exchange rate takes into account the purchasing power parity as we discussed. It also takes into account inflation between the two countries, the level of inflation. Because as I said, the same product may cost different in US and in India because of inflation. The same product may cost higher in India because we might have higher inflation. The same product may cost lower in the US because they might have a lower inflation depending upon that. So on that dependence, it is basically determined what exactly is the real exchange rate. That is how the real exchange rate is calculated. It is equal to the nominal exchange rate. The nominal exchange rate is again the common exchange rate that we talk about, multiplied by domestic price level divided by the foreign price level of the same products. So the same products, how much are they costing in India? That is a domestic price level, divided by how much are these products, the exact same products are costing in America, for example. You divide that, and that is when you get that number. That will tell you what is the real exchange rate here. Again, in common terms, on a day-to-day basis, when we talk about exchange rate, we are only referring to the nominal exchange rate. However, there are these other exchange rates that do give us a better and a much more pointed indication of what exactly is the value of your currency. So this is used by economists, but in day-to-day life, as I told you, we stick to nominal exchange rate only. Now, how is it that government and the RBI can curb the free fall or the depreciation of rupee? As I said earlier, it's very simple. The simple equation here is the more dollars or the more foreign currency that you have in your market, the better it will be for your rupee, means it will make your rupee stronger. And again, when I say the rupee will be stronger, what I mean to say is that for buying $1, you will have to spend lesser amount of rupees. So if you have more dollars in the market, our rupee will become stronger. This is how we decide how the government and the RBI will try to make sure that the rupee value stabilizes. Now, the stabilization of the rupee in India, as I said, mainly depends upon how much dollar or how much foreign currency do you have in the country. Now, in order to improve the inflow of dollar, as I told you, there are various ways in which the inflow of dollar can be improved. That is, number one, you can have remittances. Number two, you can have investment coming in. Number three, you can have more exports. This is what the government or the RBI try to do. They try to make sure that we can have as much export as possible. They can make sure that we improve our ease of doing business so that the investment coming into the country improves. That is what the RBI does and the government does. They try to reduce the current account deficit. Current account deficit simply means, in simple terms, the difference between your import and export. We always have a current account deficit. Deficit indicates the fact that we import more stuff as compared to what we export. So if we reduce that, that means we are reducing our requirement for dollars, we are reducing our requirement for foreign currency. That can work well for us. Similarly, RBI can also intervene. As I told you, RBI improves the inflow of dollars in the market. RBI makes sure that the amount of dollars in the market is improved. How? Because RBI itself has a lot of foreign exchange reserves. They try to sell that in the market. That improves the situation. They also try to make sure that the interest rates are actually more attractive. How? Why would an investor bring their money into India? An investor will bring their money into India only when they have a situation where they think they can get higher returns from India. So if our asset, if the government securities, etc., are offering better rate of interest in other countries, that can also lead to inflow of foreign currency or inflow of dollars in the country. All these things, if more dollar comes in, all these things will lead to appreciation of rupee, or it will lead to stopping the depreciation or declining value of the rupee. That is what is done by RBI and the government. FDI, that is the foreign direct investment, is encouraged. Easing external commercial borrowing means they try to make sure that it is easier to get money from outside for the corporates as well. The corporates, for example, the private companies, they also try and bring a lot of money from outside. They take a lot of loan from outside. For example, if you look at the World Bank group has 5 arms. One of them is IFC. IFC gives out loan to private organizations. So private businesses can take loan from outside as well. There are certain conditions imposed on them. So government can ease those conditions, government can allow them to get loan in an easier manner. All these things lead to more inflow of foreign currency or dollars in your country, and that leads to stabilization of the value of rupee. All these things can be done, and hopefully they have a positive impact, because see, from the side of government or the RBI, you can just hope that I will do this or I will introduce this policy, and you can just hope that it will bring a positive result. But it is not always necessary that if the government improves your ease of doing business, it's not necessary that it will automatically bring more businesses in the country. Please understand this. A decision taken on paper might not exactly translate on the ground in the exact manner that you had hoped for. So the policy decisions of the government, the policy decisions of the RBI to try and improve the inflow of dollar in the Indian market, their expectation is that the decision that they take right now will have the kind of impact that they envisage, but it is not always the case. And it might take some time to actually get translated or implemented on the ground. That is why when the rupee starts to depreciate or the value of rupee starts to decline, you will not see an immediate response, or you will not see an immediate remedy from the side of the government. Whatever they do will not have an immediate impact unless the RBI just starts selling its dollar in the market. The easiest way to improve the flow of dollar in the market is RBI just says, okay, I have a lot of dollars, let me sell those dollars in the market. That is one way to have an immediate impact, but otherwise apart from that, you do not have an immediate impact of these policies. These are the key drivers as we discussed. These are the main factors that determine the exchange rate of your currency, because again the underlying value is the same, the underlying concept is the same. Your value of your rupee against the dollar will simply be determined by how much dollars you have in the Indian market. All these things decide how much dollars can come in or how much dollars are encouraged in the market. So if you have better investment infrastructure, if you have more favorable policies for the investors, if you have better trade balance, all these will bring in more dollars, and that is what will lead to a stronger rupee, or a rupee that is appreciated against the dollar. On that note, we now are at the questions. As you know, with each and every topic that we discuss, we have a bunch of questions. We have 2 questions based on the topic that we discussed that can be asked, and we also try and take a previous year question related to it. So now that we are on the screen, I would want you to read this very carefully. I'll give you space, pause on this screen, think about what the answer is in your mind, write down that answer, and then play again so that you can evaluate yourself whether you got this right or wrong. All right. I hope you all read this. I hope you have logged in your answers. With reference to rupee dollar exchange rate, consider the following statements. Number 1, a depreciation of rupee against the dollar. A depreciation of rupee against the dollar always improves India's current account balance by boosting exports and discouraging imports. Now, please understand what they are trying to tell you. Depreciation of rupee means, for example, if earlier rupee was 60 rupees a dollar, now 1 rupee is 85 rupees a dollar. That is depreciation, means now you have to spend more number of rupees to buy a dollar. So that is depreciation of rupee. So they are saying depreciation of rupee always improves India's current account balance by boosting exports. Now, as we discussed, the exports do get a boost. Why? Because for someone sitting in EU, someone sitting in Australia, US, now that they are looking to buy Indian products, the Indian products look much cheaper, because now to buy product of 85 rupees, they only have to spend $1. Earlier, their $1 could only buy them 60 rupees of product, so that's better for them. So our exports get a boost, that part is correct. But then they say it discourages the imports. That is not always true. See, when you have lesser amount of money in your hand, when you have currency that is devaluing or depreciating, it might decrease import, but there are certain commodities that are essential for you that you have to import anyways, and the price doesn't really matter. And the single biggest example of this is crude oil. Now, crude oil is something that we are heavily dependent on for importing. Out of the entire need of our crude oil, only 15% is produced in India. 85% of our crude oil requirement is imported from outside India. So it doesn't matter even if the crude oil prices increase or even if the rupee depreciates, we can't say, oh, I will not drive a car now, I will now walk because the petrol is costly. No, you still have to buy crude oil. That crude oil demand is not determined by the price level. That is why it's not necessary that a decrease of import will happen because of rupee depreciation. That is why first is wrong. I also told you yesterday that be very careful when the statements have these words such as always, never, only. Be very careful about these whenever you see these kind of words. These are usually wrong because again these words tell you that there is no exception. So in certain cases it might happen, but it's not necessary that it will happen in all the cases. That is why be very careful with these kind of words. Second, the RBI intervenes in foreign exchange market to smoothen the excessive volatility in the rupee and not to target a specific exchange rate level. Absolutely correct. This is what we discussed. There is no ideal level that this is the level at which the rupee should be as compared to dollar. The government, the RBI can never know this because the simple argument is it works in an opposite manner for importer and exporter. It works in an opposite manner for someone being in India and someone who is outside India. For example, let's say there is an Indian who is working in the US in a good IT job and they send back $1,000 for their family every month. So for them, if the rupee depreciates, isn't it better? But if they are sending $1,000 back when rupee value is 60, then their family is only getting 60,000 rupees. On the other hand, if the rupee becomes 85 to a dollar, then when they send back $1,000, that means 85,000 rupees are given to their family. So it's better for them. For someone sitting in India, it might not seem like that, but for diaspora, it is better. Similarly, for exporters, it is better that the rupee depreciates. For importers, it will give them a headache. So there is no one single value that we have to aim for. There is no one single level. It is just that the government and the RBI try to reduce volatility. That is bad for business. When a foreign company, for example, comes into your nation and they invest a lot of money, they are not asking you that we want one specific tax rate. Yes, the lower taxes are preferred by them, but what they really want is stability in the taxes. It can't be that 10% this year, 12% next year, then 20% after that. No. As long as it is stable and nearby stable, that is how it works better for them. So, second is absolutely correct. Third, the real exchange rate and adjust the nominal exchange rate by considering inflation differential and trade weights with the major partnering countries. That is what we discussed. There are different types of exchange rates. There is a real exchange rate, there is a nominal exchange rate. Nominal exchange rate is the one that we usually talk about in our day-to-day language, but that does not take into consideration inflation and the cost being different in different countries of the same product. For that, we have a different parameter called the real effective exchange rate that takes into consideration inflation and the prices of commodities as well. So, 2 and 3 are correct. First statement here is wrong. The answer thus will be B, 2. 2 of these are correct. First statement here is wrong. B is the answer. Okay. Moving on to the second one. Again, I will urge you to do the same thing. Read this completely, very carefully. Take a pause on this screen. Think about what the answer should be in your mind. Lock in your answer and then you can play again so that you can see whether you got this right or wrong. All right. The question is, consider the following potential determinants of rupee dollar exchange rate movement. So basically what they are asking is which of these factors determine or at least influence the rupee dollar exchange rate. First, interest rate differential between India and the US. Now again, you have to just ascertain that which of these will impact the inflow or outflow of dollar from the Indian market. If these factors impact the inflow or outflow of dollar, that means they will have an impact on the exchange rate. So first, interest rate differential between India and US, yes. Why? If India is offering a better interest rate for investors, they would run and bring their dollars into India because they want more money, they want the money to compound. So the differential means the difference between the interest rate in India and US. If it's a big difference, if India can offer more interest, it's better for them. So first, yes. Trade deficit level of India, again yes. Why? If we have a huge trade deficit, that means we are not earning enough dollar and we are spending a lot more dollars to buy stuff. There is a deficit between the trade. That is why it is a bad sign. So that would lead to dollar outflow from India. Third, portfolio capital flows from foreign institutional investors. Yes, because it will bring in more dollars in the country, so it will stabilize the rupee, it will not let it depreciate a lot. Gold and crude oil prices in international market, again yes. Why? Because if the prices increase, then we will have to pay more dollars to buy the same amount of crude this year as compared to last year. So any increase in the crude oil prices will mean more forex exchange or more dollar outflow from India. So all these factors will determine or will play a role in rupee dollar exchange rate. All these four are correct. The answer should be D. All these four are absolutely correct. I hope you got this one right. This was not a difficult question to answer. If you want, you can take a screenshot for your reference here if you want to revise it later on. Then I have a related previous year question for you. This was a question asked in 2019. Again, try and read this, maybe take a pause on the screen and think what the answer should be from your mind, and then you can play again. Alright, the question is, consider the following statements. Number one, purchasing power parity PPP exchange rates are calculated by comparing the prices of same basket of goods and services in different countries. Yes, that is what I discussed earlier as well. Just because $1 is equal to 80 rupees doesn't mean that you can buy the same commodity of 80 rupees in India and the same will not be sold at $1 in the US. There is a price difference between the two. This is where you have to take into consideration something called purchasing power parity exchange rate. They take into consideration the same products which are sold in both the countries but at different prices. So they take into consideration how much value of that currency would you have to spend to buy the same product in the other country. Next, in terms of PPP dollar, India is the 6th largest economy in the world. No, in terms of PPP dollar, we are the 3rd largest economy in the world. After US and China, we are the 3rd largest, not the 6th largest. So out of this, first statement here is correct. The answer thus would be A. The first one is correct, the second one is wrong. A would be the correct answer. Not a difficult question. This was asked in 2019. Okay. Time for us to move on to the next topic then. The next topic that we have is something that India holds very dear, something that the government of India is extremely proud of and should be. This is called remittances. India is by far the largest recipient of remittances amongst all the countries in the world. In simple terms, remittances means the Indians who go abroad to work. For example, there are people who have gotten jobs outside, or maybe they took a degree from outside and they started to work. Mind you, they are Indians only, just that they are working outside, they are earning now, their families are back here in India. So a part of their savings, they send that money back to the country. That is called remittances. India usually always remains at the top, but from the past few years, without any exception, we have remained at the top in terms of remittances. India also became the first country in the world to receive over $100 billion of remittances in a year, and that number is just increasing. Now, remittances is extremely helpful for us. The reason being, this is a major source of foreign exchange for the country. Now, please understand, remittances, when they come back to India, they are not an earning of the government. They are not an earning of the RBI. Because if government of India or the RBI, for example, receives $100 billion from outside, they have to spend or they have to give equivalent amount of money in Indian rupee to the families. So it's not an earning for the government or the RBI, but it allows us to get a hold of much more foreign exchange. And this is why it is so important for us. India has become the top recipient of remittances in 2024 with about $129 billion, which is the highest ever. Now, remittances is something that you usually see in developing countries only. because it is the developing countries where the pattern is that people to find a better job, to find a higher paying job, to find a better lifestyle, they would move to developed countries. And more often than not, their family members, a lot of them remain in the country and they send that money back. So it's not really a feature of the developed countries. You would not expect someone from the US to shift countries to shift country and go to some other country and then send the money back. It's not that they don't do, some of them do, but not in that large numbers. It happens much larger numbers in developing countries. India, China, Mexico, even Pakistan, for example, does receive significant amount of remittances from its citizens globally. Now, remittances, as I said, is the money that the individuals working abroad will send back, and it's not right now, but for a very long time, at least after 1991, ever since the LPG reforms were introduced and the movement of people became easier, ever since that, remittances have been a very important source of earning foreign exchange for RBI and for the government. This is something the government does not ignore. Now, if you just see this, these are the countries that are the top receiver of remittances around the world. Some names might be surprising, like you can see Pakistan here. As I said, all of these are developing countries only. India at the top, Mexico, then China, Philippines, Pakistan. This is the ranking of 2024. It keeps on changing year on year. Now, I have told this earlier and say this once again, for the prelims examination point of view, you do not have to remember the exact data, the digits or the numbers. You have to remember, however, the trends. So, UPSC will not ask you how much remittances did India receive. They will not ask you that. But they will ask you that amongst these countries, which is the highest country or which is the highest receiver country. They might ask you to rank these countries in the order, increasing or decreasing order of recipients. They won't ask you how much money did India receive. They will ask you to rank that in the order. So you must know the rankings in this kind of a trend, even if you do not know what exactly is the number that India is receiving in the form of remittances. Now, this is the trend. Remittances usually obviously go to low income country, middle income countries, because you don't expect developed countries or rich countries to have many people outside and then sending the money back. China, interestingly, what has happened with China is China's remittances are decreasing. There was a situation, or there used to be a case where China used to be a top receiver of remittances, if not the top, at least the second highest along with India. But what has happened in China is that the amount of remittances that they are receiving is decreasing. Now, how do you interpret that? If a country is receiving lesser remittances as compared to what they used to receive earlier, there are two big factors that are responsible for that. One positive and one not so. The positive factor in this case is maybe, just maybe, the citizens are not going outside because they are finding enough good opportunities within the country now. Because understand, why would a remittance or why would a person go outside the country? A person moves outside the country for economic opportunities when they think that they don't have enough jobs within their own country, or they don't have enough high paying jobs within the country. So if a country or a government is able to ensure that you have enough jobs, high paying jobs within the country, will not move outside. So that is one example. That when a country starts getting lesser remittances, maybe you are developing yourself, so there are enough job opportunities. So that is one factor which works in China's favor, because a lot of job opportunities have opened up in China itself. Then there is a second factor involved as well that may not be that positive. The second factor is that your own population, in case of China for example, China has an increasingly aging population. The average age of China is increasing, and it does happen, especially in a case of China. They had the one-child policy for such a long time. Now they have relaxed it, but due to one-child policy, the population rates declined. And when you are in a situation where you have improved your healthcare, improving healthcare would mean that the people will automatically have a much longer life as compared to earlier. So people having a longer life, people not giving birth to many more babies, that means your population is now becoming older. So when you have a population that is becoming older, aging population, obviously you will not have a lot of them going outside. Usually it is the younger people's play that they go outside and they take up jobs and they earn more money, they try to risk more so that they can earn more and send it back to their family. That usually does not happen with aging population. So these are two important factors that can lead to declining inflation. Again, one positive because you might have job opportunities within the country, and one negative that maybe your supplying labor, labor supplier or a talent supplier tag may not be that positive or may not be that strong anymore. Now, if you look at India's trend, for India that situation has not happened so far. In India's case, in the last 3 years at least, the amount of remittances that we have received have consistently increased. Again, I'll repeat once again, these kind of trends are important. So, UPSC for example can ask that since 2022, the amount of remittances India receives has consistently increased. That is correct. In 2022, we received about $110 billion, then 125, 129, and all these years, India has remained the top receiver of remittances around the world. So, in all these years, it has been enough to make India the top receiver of remittances, which has obviously worked very well for India. Also, it's important to understand from where is it that the money is coming from which countries or from which part of the world are we earning most of our remittances. The biggest chunk of remittances that enter India is from the US. Close to a quarter, to be exact 23.4% of the remittances that we are getting actually coming from the US. That is the largest source of remittance coming into the country. Then the familiar area where a lot of Indians go and work. A lot of Indians often in blue collar jobs, but they do go and work. For example, UAE. UAE is the second largest source of remittances for India. 18% of remittances, 18% of all the amount coming in from outside the country is coming in from UAE. Apart from UAE, as you know, there are many other countries in West Asia or Middle East as it is called, where a lot of Indian workers are working, especially in the blue collar jobs. They also spend or they also send back considerable amount of remittances back to their family members. For example, countries such as Saudi Arabia, Kuwait, Oman, Qatar, all of these together, the Gulf countries as we call them, make about 11% of remittances. Now again, these kind of numbers, these kind of data points are important. They can be asked, what are the parts of the world from where we get most of the remittances, what are the parts of the world from where remittances are increasing, etc. So remember, it is the US from where we get most of the remittance in India, followed by UAE and then the bunches of the Gulf countries. In terms of amount, if you are interested in that, again, you don't have to remember the amount, but just for your reference so that you understand, the amount that India receives 129.2, it is almost, not exactly, but almost double the next country, almost double. Mexico much lower, 68, then comes China, Philippines, Pakistan. So these are the top 5, but just for our interest sake, let's look at the other countries as well and you will be able to see the trend. How and why am I saying all these are developing countries? Bangladesh, Egypt, then Guatemala, Nigeria, Uzbekistan, Indonesia. So a lot of countries from Asia. In fact, a lot of our neighboring countries you would see here. You have already seen Pakistan in our neighbor, China in our neighbor, Bangladesh in our neighbor. Then you will also see Indonesia, Vietnam. There is Nepal also, Thailand also. So there is a culture of this part of the world, of Philippines also, sending people outside, and then a lot of them send the money back to their country. So a lot of these, almost all of these are developing countries only, because again this is something you see in developing countries, and this is one good outcome of our huge population. You know, very often we say that the population of India is a big burden on us, which is correct, but a big part of our population is the factor that is responsible for India having so many remittances. Again, I'll tell you, numbers are not important. You don't have to remember the exact data here, how much money is going into which country, but yes, you would do well to remember the trend. So, for example, try and remember the top 5 at least in that order, so that you can put it in that order if asked. So, India followed by Mexico, China, Philippines, Pakistan. That is the order that we have seen in 2024. That is the last year numbers that are available to us. Now, why is it that we get so much remittances? Not that we are complaining, but what exactly are the factors? First big factor, the scale of migration. Now, Indian diaspora, that is the number of Indians around the world, is by far the largest in the entire world. It also helps that because of our language formula. Now, although 3 language formula was not followed in most parts of the country, but at least 2 languages were taught. Because of which English has been taught in most of our schools across the entire country. India, because of this, has the largest English speaking population in the entire world. Please understand, we have the largest English speaking population in the entire world, because of which we are a suitable country to provide large scale skilled or unskilled labor. This is why India gets a lot of this money. So over 18 million Indians, so 1.8 crore Indians reside abroad as of 2023. It's a huge number. Then shift in destination trends. Again, as we have seen, a lot more Indians are going to other countries such as US, UK, Australia. Skilled and unskilled, both kind of laborers are in great supply from India. You see a lot of unskilled labor going to what you call as West Asia, Middle East countries, working as, let's say, construction workers, tailors. Those are unskilled labor, and then blue collar jobs, and then there are skilled laborers working in the IT jobs, consultancy, etc. They are working in big banks, and you would see them working in Europe, working in US. So India is a supplier of both kind of labor, skilled and unskilled, and both of them do send considerable amount of money back to the country. Now let's see if you are able to answer some questions based on what we just discussed. Again, read the question carefully, pause on the screen and lock in your answer, think about what the answer should be, and then you can play. Alright. With reference to remittances in India, consider the following statements. Number 1. As per the latest RBI data, inward remittances to India are now primarily sourced from high-income countries, with the US emerging as the largest contributor. We did discuss this. US is the largest contributor. The proportion of remittances used for capital formation like investment, property, purchase, etc. has consistently exceeded the proportion used for consumption purpose in rural India. So what they are trying to say is that the remittance money that comes back in rural India, much bigger part of that money is spent in building property and investing, and a lesser part is spent in consumption. Consumption means eating and these kind of things. That is wrong. So RBI, for example, also tracks how the money that is coming from remittances is being spent. Means not the minute data, but just the overall themes of where exactly or in which particular area are you spending most of the money that you are getting in the form of remittances from your relatives outside. As per that, a lot more money or a lot bigger money is spent in the consumption area or in the consumption field by the rural India, and not in the field of building some infrastructure. India has been the top recipient of global remittances for over a decade, with inflows consistently exceeding FDI inflows in recent years. That is absolutely correct. We get much more money in the form of remittances as compared to FDI. The government of India tries to increase FDI, that is foreign direct investment, trying to bring in more investors into the country, but somehow that has not increased as much as our remittances have. So 1 and 3 are correct, 2 of these, B would be the correct answer. You have to tell how many of these are correct. Okay? If you want, you can take a screenshot of this explanation for future revision. Next. Consider again, you can read it carefully. First, read it, pause on the screen, lock in your answer, whatever your answer you think is this, and then you can play it again and see if you got this right. Okay. I hope you read this. Consider the following effects of increasing remittances inflow on the Indian economy. So when remittance inflow increases, what exactly happens? Number 1. Remittances improve the current account balance and act as a buffer against external shock. Absolutely correct. Through remittances, we have more foreign exchange coming into the country, which means we will have more foreign exchange to buy external goods, to buy our imports. So that will help us against any external shock. External shock means all of a sudden if the price of oil increases, all of a sudden there is a global dispute, we would have enough foreign exchange in our hands in order to sustain that issue. Persistent and high remittance inflows can lead to Dutch disease effects in the economy. Yes, we will discuss Dutch disease in just a bit, but yes, it might have this problem and it has been seen in the past. We'll just discuss after this question what exactly do you mean by Dutch disease. Remittances are included in India's GDP? No. They are not included in India's GDP. So, they are not considered as national income. Why? See, GDP is the income of everyone living in India. It is the income of everyone living within the boundaries of the country. If you have to include the income of Indians living abroad, that is included in GNP. So, gross national product, for example, if you are imagining that or if you are trying to calculate that, then you would include this, because again, remittances is an earning and income of the person, also an Indian, but he is not living in India. With GDP, you are just calculating the amount of money that is being made by people living in the country. If you want to add remittances, that will give you GNP, that is the gross national product. Gross national product, as you know, is the income of all the Indians, either living within the country or living outside the country. That is how it usually works. So, the answer would be 1 and 2 are correct, that is A. The third statement here is wrong, 1 and 2 here are correct. Now, if you want, you can take a screenshot. As I said, the question that I just asked you had a very interesting phrase here that you should know. That phrase used in the question is something called the Dutch disease. It's a very, very interesting scenario of what exactly do you mean by Dutch disease. Now, what is Dutch? Dutch is the name given to Netherlands. It's not a disease that started in Netherlands, but it's an economic phenomena which surprised many people. Usually, let's say in a country, you all of a sudden, let's say in case of India, all of a sudden, let's say we find huge oil deposits. Let's assume this situation, that huge oil deposits are discovered in India. Now, you might think it's a great news for India, which is, because it will bring a lot more money, it will bring a lot more foreign exchange. Now, what will happen in such a scenario? Because we have discovered oil, we will start selling it, and the result will be a lot more dollars will come into the country. Now, remember we discussed the more dollars you have in the country, the greater your currency will be or the stronger your currency will be. So, you have a situation where a lot of dollars are coming in, because of which your currency has become very strong. Very strong means they might have a situation where $1 may be equal to only 10 rupees or only 5 rupees. Or even may have a situation where $1 is equal to 1 rupee, because we have so much dollar coming in. Because the amount of dollar in our market will determine the value of rupee and dollar. Now, imagine this situation. Looks like a dreamy world, right? But it is a very bad situation for exporters. Because if our rupee strengthens to very fast level and the exporters are not able to export stuff, it will lead to economic issues within the country. Please try and understand this. As I told you earlier, when our rupee depreciates, it's good for exporters from India, because someone sitting in the US would be able to buy Indian stuff at a cheaper price. But now that if our rupee is actually getting stronger, that means they would have to spend a lot more money buying products from India. So, when you have a lot more dollar inflow, when you have a lot more inflow of foreign currency into your country, your currency will appreciate or will become so strong that the other sectors of your economy, apart from the natural resource, apart from the oil, etc., other sectors will suffer, because they will not be able to export anything because your currency has become so strong. That is what is called as Dutch disease. Again, Dutch disease means that you have found a natural source in your country, oil most probably, because of which you get a lot more foreign exchange, because of which your currency starts to become strong, and it becomes so strong that now your exporters are worried that apart from oil, you are not able to sell anything else, because everything else is so costly now for a foreign investor that they don't want to buy from your country. That is a situation of Dutch disease. Ultimately, it will harm your other sectors apart from the one where the discovery was done. The idea of the Dutch disease, and why do we call it, first came in 1982. It was proposed by an economist, Peter Neri, specifically because it happened with Netherlands. Now, what was the case with Netherlands? Let me tell you. In Netherlands in 1960s, They suddenly had discovery of gas reserves in the North Sea. They were extremely happy that, oh, we have so much gas now, we'll be able to sell it to the world, we'll be able to become this energy hub, we won't have an issue. And this did start a lot of foreign exchange coming into Netherlands. But because of this foreign exchange coming into the Netherlands, all the other sectors started to decline. All the other sectors started to have an issue because there was no other export happening. And when no other export happens, obviously other industries will suffer and there will be unemployment. So there was a situation where unemployment rose from 1.1% to 5.1%. Despite having discovery of gas, capital investment also dropped. This is called as the Dutch disease. So it's a very interesting situation where if you don't play it right, if you don't have your correct policies, even if you find out some natural resource in your country, even if you find out crude oil or gas, it might actually lead to your own detriment. This is what happens in what is called as the Dutch disease. Do remember that. I have one more related question for you. This was asked in 2015 in the prelims examination. Read this carefully, maybe take a pause on the screen and then read it. See if you can answer this. I'll give you a few seconds. Alright, the question is, with reference to inflation in India, which of the following statements is correct? First, controlling inflation in India is the responsibility of the government of India only. No. On the contrary, it is the primary responsibility of the RBI, Reserve Bank of India. Government also plays an important role here because the government knows if inflation becomes too much, it will harm the election prospects. If they go and ask for votes, people will not vote for them because there's too much inflation, too much price rise. The primary responsibility is with the RBI. Reserve Bank of India has no role in controlling inflation. No, we just discussed yesterday. RBI in fact has a proper committee called Monetary Policy Committee whose responsibility is inflation targeting to make sure inflation remains within the range of 2 to 6%. Decreased money circulation helps in controlling inflation. Yes, that is the primary source of fighting inflation in India. Whenever the inflation goes out of control, what the RBI mainly does is they try to make sure that money supply in the country is controlled. They try to reduce money supply. They try to make it difficult for the banks to offer loans so that people don't have enough money in their hands. So C is the correct answer. This is what happens if you have to control inflation. If you want, you can take a screenshot here. If you want, you can revise it later on. The next important topic in the news is Foreign Exchange Management Rules 2024. As the name suggests, these are rules about foreign exchange management. In simple terms, how much money can leave the country, how much money can come into the country in terms of foreign currency specifically. If you are going outside the country, how much money can you take? All these things are bound by certain rules called as the Foreign Exchange Management Rules. Now, the reason why it is in the news is because the Finance Ministry made certain changes to these rules and thus these are important for the examination. They amended these rules, simplifying the FDI rules for cross-border share swaps. So, for example, if any Indian company has, let's say, money coming in from US, let's take this example of Flipkart. A few years back, as you know, Flipkart was bought by Walmart. Walmart brought in all that money into the country and they gave the money to people running Flipkart and they said, take this money, transfer the shareholder, transfer the ownership to me and I will run the company from now onwards. Now, this is referring to exchange of equity or swapping of equity in exchange of money. This is not very easy because a lot of rules have to be followed for that. So, what the government did was they eased out the rules for that. They made it easier to swap ownership or to exchange shares in exchange of money in case a foreign investor, for example, is coming in. Because when you have to do it within the country, it's not that difficult. But when a foreign country is involved, a foreign entity is involved, that is when it becomes difficult and there are many rules involved here. So, this is where the rules have changed. Now, what exactly are the change rules and what exactly has happened? Let's try and see what is the argument in these rules. First, the simplification of cross-border rules has happened. The aim is so that we can attract more investors from outside. because only when the investors have this faith that if I bring my money into India, it won't lead to many complications. Only when they have this faith would they be interested in bringing their money back to India. So one, it has, the objective is to bring in more investment. The objective is to make it easier for others to actually get their money. Second, the government under these rules also said that FDI in white label ATMs will also be allowed. In fact, there will be 100% FDI under automatic route, means without the government's permission. Now, ATM, I hope all of you have used ATM at some point of time, those machines where you can withdraw cash from your account using your debit card. Usual ATMs that you might have used are the bank run ATMs, Axis Bank, ICICI, SBI, SGFC, Punjab National Bank, all of them have their own bank run ATMs. But there are certain other ATMs as well. I'll discuss that in just a bit. Then there's something called white label ATMs. White label ATMs are those that are not run by banks. They are run by certain other third party company. Let's say Tata. So Tata doesn't have a bank, but they might have an ATM. So you have a bank card, you go to that bank and there's the ATM and you can withdraw the money. They will charge some money from the bank for providing this service to their customers. That will lead to financial inclusion. That will lead to a situation where more people have access to ATM, because the banks, for example, don't want to build this infrastructure. The bank will say, oh, let me be focused only on my working, let me just focus on what I am trying to do. Let me focus on opening bank account, giving loan. I don't want to be involved in opening ATM and all. So a third party will come in and say, don't worry, I will do it for you. Let me handle this work for you. That is where the white label ATMs come in the picture. So white label ATMs, again, the important news is that 100% FDI is now allowed in these white label ATMs. Apart from that, there are some other things that are a part of this foreign exchange rule. The definition of a startup company. The definition of a startup company in India. Now, as you know, every new company calls itself a startup. But there are certain strict regulations and rules under which you qualify to call yourself a startup. Now, what are these rules and what are these regulations? So, basically, the Department of Industry and Internal Trade, they are the ones who decide this. The two parameters are, number one, you can be a startup for up to 10 years of the date of incorporation or registration. So, the date, the time when you got registered, from that up till 10 years, you will become or you can be called a startup if you are a private limited company or you are a registered company as a partnership firm or a limited liability partnership, that is called an LLP. So, in this case, you will call it a startup. Secondly, if you go above a certain level, then you won't be called a startup, certain level of revenue. So, turnover of the entity for any of the financial year since incorporation has not exceeded 100 crores. So, the moment that your turnover means the money that you are earning, that turnover is something that should not go beyond 100 crores. The moment it goes beyond 100 crores, you will not be called as startup. So, these are the two parameters, do remember these. First, up till 10 years of incorporation. Secondly, in any of these years, even if in 1 year your revenue, your turnover rather exceeds 100 crore, you will not be in this category. It has to be under 100 in all these years. Now, why is it important to have this definition? It's important to classify them or define them because you see a lot of government schemes, a lot of government programs specifically for startups. So, for example, when the government says that startups can take loan at a lower rate, or the government says we are launching a new fund for startups, or the government says we are providing a certain kind of facility for startups. For all of that, it is first important to define what a startup is. And in the absence of this particular definition, you can have many more companies trying to take advantage of it. That is why it is important. Now, as I was telling you about ATMs, because the rules specifically talk about 100% FDI being allowed in white label ATMs, again 100% FDI and that to 100% automatic route FDI means you don't even have to take the government's permission, you can just bring in the money and start the work. Now, on that note, remember there are different types of ATMs that you would come across. Some of these are very rare. Some of these are the usual ones that you see. For example, the usual ATMs are the ones that you basically go and the banks own those ATMs, those are your banks. Apart from that, there are, for example, ATMs called the green label ATMs where they offer money specifically for agricultural purposes. Then there are pink label ATMs. Pink label ATMs are specifically for women. the idea here is that women, for example, in certain ATMs, you might have a longer queue time or you might have longer wait time. They might not be very safe to stand for a long period of time. So specifically for women, there are pink label ATMs, very rarely found in India. Orange label ATMs for share transactions. These are not for withdrawing cash. These are specially to transact for your shares. If you want to sell or buy shares, you can do that using that machine. If you don't have your own machine or laptop or your mobile phone, you can do that using these. Yellow label ATMs, they are mainly for e-commerce transactions. If you want to buy something from e-commerce websites, you can do that. White label ATMs are the ones that we were talking about. These are the ones that are mentioned in these rules where 100% automatic FDI has not been allowed. These are operated by entities, authorities or companies which are not banks. They basically may have a tie-up with the banks and they may charge a commission with the bank like Tata, etc. And then brown label ATM operated by third party other than a bank, where they are banks have basically given a contract to someone else to run ATMs for them. These are rarely found in India. Very rarely would you see these kind of ATMs are very rare. You might see some ATM being run by Tata as a white label ATM. But again, most of the ATMs in India are operated by banks only because they don't want to have any intermediary in between. See, for all of these things, if the bank is not doing this, they would have to pay a commission, they would have to pay some charges to some other company or organization, and they would not want to do that in any case. So avoiding that is usually the best strategy that the banks have, and that is why it's very, very rare that you would have these kind of ATMs. You would hardly ever see a pink label ATM, etc. But these are things that I've seen around the world in other countries also. That is how the ATMs usually are operated. On that note, let's see if you are able to answer the questions based on these. Again, read this carefully and maybe take a pause on this screen, lock in your answer, think what the answer should be, and then you can play again. All right then. So the question is, with reference to foreign exchange management, that is non-debt instrument amendment rules of 2024, consider the following statement. Number one, the rules now permit 100% FDI under automatic route in the space sector for launch vehicles and satellite manufacturing. Is it correct? Think about it. That is correct. Now we do have 100% FDI for space sector also for launch vehicle and satellite manufacturing as well. In fact, you will see a lot of Indian startups also in cities such as Bangalore, Hyderabad actually working on a lot of satellites being made. India's IRNSS, which is called a Navik, that is India's own version of the GPS, which ISRO has launched. One of the satellites that they have launched is actually a satellite that is made by a startup, and now government is inviting foreign investment also in this field. Investment from countries sharing a land border with India continue to remain government approval irrespective of ownership structure. That is correct. If you remember, we discussed this yesterday as well when we were discussing a topic of how an FPI can get converted to FDI. And one of the points was that if the conversion is from a country which shares a land border with India specifically, that has to be after the approval of the RBI. This is where the same thing happens. India is very wary of investment coming in from countries with which we share a border, specifically concerned with China, Pakistan specifically. So we do have these kind of clauses. Second is correct. Third, the amended rules remove the earlier sectoral cap on foreign investment in nuclear power generation for public sector enterprise. That is wrong. So nuclear power generation is one of the few things in India where we have still not gone into privatization, but the government has allowed permission wise, that is basically based on whether the government gives permission or not, but on a case to case basis, the government has now allowed some foreign investment coming into PSUs that are generating these power plants, that are running these power plants for nuclear energy. So again, some FDI is allowed in those government companies, PSUs that are operating the nuclear power plants. They will be as per the government's permission. They will not have complete ownership. Ownership will remain with the PSUs only, but there is some FDI coming in. So there is no removal of sectoral cap here happening as such. There are strict regulations here even right now. Two of these are correct, first and second. The answer thus would be B. The third statement here is wrong. If you want, you can take a screenshot here if you want to revise it later on. Moving on. Again, read it carefully. maybe lock in your answer, think about what the answer should be, and then you can play again to see if you got this right or wrong. All right. Which of the following regulatory outcomes have resulted from the Foreign Exchange Management Amendment Rules of 2024? Because these are the rules that we discussed. First, the Indian residents are now permitted to remit funds abroad for overseas education and medical treatment without prior RBI approval, irrespective of the amount. This is the problematic part. It is not irrespective of the amount. I'll just discuss a thing after the question ends. In India, we have something called LRS, that is Liberalized Remittance Scheme. Liberalized Remittance Scheme is a scheme under which RBI decides how much money can you take or how much foreign currency, for example, can you take outside the country. So it's not that you can remit funds abroad without any limit. There is a limit. For example, the general limit is $2.5 lakh. That's the general limit, $2,50,000. Apart from that, the RBI can decide on a case-to-case basis. So when you say that irrespective of any amount, you can remit outside, no, that is not true. There are restrictions for it. It's not irrespective of the amount. So first is wrong. Revised rules clarify remittance and the LRS are now subject to tax collected at source irrespective of the purpose of limit. That is correct. So there are different types of taxation system of how tax is deducted. There is TDS, tax deducted at source, where when you usually get a salary or an income from an organization, they will first deduct the tax and then they'll give the remaining to you and then they'll deposit that tax with the government. Then there's TCS, tax collected at source, where again we would have to collect or give the tax specifically at the source. They will not deduct it from you. The amendments has introduced a new classification of strategic capital account transactions with differentiated approval process. That is also correct. So what the amendment has done, that in certain cases, certain sectors are too important for the government. They will be strategic capital accounts transactions. For them, the approval process will be different. The government will look into them differently. Second and third are correct. B is the correct answer here. First is wrong because it is not irrespective of any amount. Okay, this is where, if you want, you can take a screenshot for revising it a bit later on. Now, as I told you, I'll just give you a few minute details about the LRS since we did discuss this. LRS stands for Liberalized Remittance Scheme. You know, we did discuss a topic on remittances and we mainly talked about remittances coming into the country, India being the largest receiver of remittances. But what we did not discuss was a situation where Indians within the country can send fund outside. You have to do that, right? If you are going, for example, to study MBA from US or European country or Australia, you might have to send money outside as well. That will also be called a remittance. For that, there are certain rules in place. It comes under a scheme called LRS that is governed by RBI, introduced in 2004 specifically. Under this, a specific amount of money can be remitted within a financial year. And now, again, the limit usually is, as I said, $2.5 lakh per financial year. This is per financial year. So the next year, for example, if you want, you can again send it again. It can be used for it can be used for specific purposes. There is a list of things on which it can be used. This is where that money can be used. So for travel purposes, medical treatment, payment of fees, gift, donation, maintenance of close relatives, investment in share debt instruments. This is where the RBI permits you to use it. And also there are certain restrictions in place. It is not available to corporations, partnership firms, trusts, etc. And individuals can open and maintain account in foreign currency with banks outside the India for transactions. So it is highly regulated by the RBI. They do keep a keen eye on how much money you are sending outside. By the way, if you ask your grandparents, or not even grandparents, if you just ask your parents, it's a very big change from where we used to be. If you just go back about, let's say, 35, 40 years, 35, 40 years ago, if you had to go out of the country, let's say you are traveling to the US, the maximum amount that you were allowed to carry in terms of foreign exchange was $20 a day. Imagine, $20 a day was the maximum amount of foreign exchange you were allowed to carry because the government was so worried about foreign exchange going out of the country. From that to a situation where you can remit at least $2.5 lakh a year, we have taken a long jump from where we used to be and to where we are right now. Anyways, I have a related previous year question for you here. See if you can answer this one as well. It was asked in 2012. Read this carefully, think about what the answer should be, and then maybe pause and then you can play it again. All right. Which of the following would include foreign direct investment in India? That is, which of the following basically would be considered as an FDI in India? We did discuss this yesterday when we discussed in detail about FPI and FDI. Should not be that difficult to answer. Subsidiaries of companies in India, yes. Companies that have their subsidiaries working in India like Google, etc. Major foreign equity holding in Indian company, yes. Companies financed by foreign companies, yes. All these are FDIs. Portfolio investment, no. This is FPI. We discussed this yesterday. Portfolio investment coming in from outside in mainly stock market, mutual funds, etc. That is a example of FPI, foreign portfolio investment. 1, 2 and 3 are correct. D is the answer. 1, 2 and 3, all these are in the category of FDI, that is foreign direct investment coming into the country. You want to take a screenshot? You can. Moving on to the next topic. The next topic that we have is Vostro, Nostro and Loro account. Now, Vostro and Nostro are something that you might have heard a lot in the news. It's related to the banking system. To understand this, it's not that difficult. For example, let's take this idea. Let's say an Indian company is selling something in Sri Lanka, right? Now, Sri Lankan company has to pay the money back to India or the Indian company because they bought stuff from here. So, how do they pay this money? You can say pay it through the bank, simple, but how exactly does it happen? So, for that what happens is, let's say an Indian bank, let's say SBI, will open up an account in a Sri Lankan bank. So, let's say SBI will, let's say, go to Sri Lanka. Sri Lanka, let's say, has a Bank of Sri Lanka. In that bank, SBI will open an account and that person from Sri Lanka can just deposit money in that SBI account without having to bring money into India. So, the Sri Lankan who had to pay the Indian company, rather than sending the funds to India, can go to their own bank in Sri Lanka. In that bank, there's an account number given to them. That account is owned by SBI. They can deposit the money there. This is called Nostro account of SBI. Nostro account means an account that you have in a foreign bank to receive money from an individual in that country without having to bring that money back into India. This is called Nostro. Nostro is a Latin phrase that translates to ours, that this is ours. Opposite of that will be Vostro. Means opposite of that will be Vostro. For example, for Bank of Sri Lanka, that account of SBI is called the Vostro account. When you hold a foreign bank's account in your bank in order for them or help them do transaction, that is called the Vostro account. Slightly confusing, but not that confusing if you actually try and remember this. Now, why is it in the news? Because the government has planned to introduce the rupee Kayat payment system. Kayat basically is what? It's the currency of Myanmar. So, they have introduced the rupee Kayat trading system specifically through the Vostro account, so that the pulses that we are importing from Myanmar, their payment can be made easily. Means what is happening here? India imports pulses from Myanmar. So, India has to pay the money to Myanmar. So, we are saying rather than bringing the money all the way to Myanmar, let's do this in our own bank, in PNB, let's open up an account. We will open up an account of a Myanmar bank. And the government will just deposit money here. They will deposit the money in this bank account in PNB, in a Myanmar bank. This is called the Vostro account if PNB calls it. So, for PNB, it's a Vostro account. For that Myanmar bank, the same account will be called Nostro. So, it is one account only. Just that the holder of the account, that is where the account has been opened up in that bank, let's say PNB, we will call it Nostro, that means yours, it is your account. And for the Bank of Myanmar, because it is their account, they are the ones who are operating it, it will be called Nostro. That is the difference. So, do remember this. Nostro translates to ours and Vostro translates to yours. Both of these accounts are the ones that that operate in foreign currencies. They are operating in foreign currency. So if PNB, for example, has opened up an account in America, then an American will deposit money in that, obviously in dollars. So it's in foreign currency as compared to their currency. Similarly, if an American bank has opened up their account in India in PNB, someone will deposit the money in Indian rupee. So that again will be foreign currency for them. So again, just I'm reiterating this. If PNB has opened up an account in a bank in Sri Lanka, for PNB that account is called the Nostro account, that is our account. On the other hand, for that Sri Lankan bank, they will call it the Vostro account. That is how it changes. The same bank account is called by different names depending upon who is actually referring to it. Is it yours or is it mine? Now, why is it that the banks do that? Why is it that you have to have this complicated system? It is just to make the trade simpler, so that again, if an Indian consumer or if an Indian exporter is selling something to a person in Bangladesh or Sri Lanka or in any part of the world, let's say they are selling something in a country called Paraguay. Now, how will the person sitting in Paraguay send the money back to Indian exporter? Rather than going all through hassle, the Indian exporter will go to its bank called SBI. SBI will tell the consumer, don't worry, you don't have to do anything. We will open up an account in a bank in Paraguay. So that person from Paraguay can come and enter the account or go to the bank and just deposit money in our account, and we will transfer it here for you. Banks do that so that they can earn foreign exchange, because for the bank, getting the money in the other currency is valuable. That means that they will be able to earn foreign exchange. It will bring in more business for them. It helps them to do international transactions. For example, it was a lot in the news when India was buying or still is buying humongous amounts of oil, crude oil from Russia. As you know, ever since the Ukraine-Russia war has started, we have been buying a lot of crude oil from Russia. So how is the payment made? For that also, there were these accounts opened up, where Russian banks opened up their accounts in Indian banks like SBI, PNB, ICICI, etc., where Indian government would just deposit the money in that account, and that is how the money got transferred to Russia. That is how the Nostro account works. It helps the banks in managing liquidity. It allows them to have significant amount of foreign currency as well. So when the time comes, they can make use of that. It allows them to have foreign operations, foreign presence. It allows them to have or give a push to trade as well. This is how Nostro and Vostro account is. Again, if you still have confusion, just read this part and it will be much more clear to you. If an Indian bank, let's say SBI, wants to open up an account in the US, they will get in touch with the US bank and they will open up an account there. Now, this account for SBI, they will call it the Nostro account. SBI owns that account, that is Nostro for SBI. While the bank in America, where this account is opened, Bank in America will call it a Vostro account for them. So the same account is known by different names, depending upon who is operating it and in which bank has the account been opened up. This is again an important part of import and export between the two countries. The Vostro account, in that account, that bank gets local currency transactions, because again, for Bank of America, that account is a Vostro account. So the person coming in, bringing in the money will bring in dollars only. So for them, it's a local currency. So Vostro account for a bank gives them local currency transactions. It again improves your relationship with other banks. See, we are living in such a globalized world right now that all the banks must maintain good relationship with as many other banks in other countries as possible. International transactions are becoming more and more common these days. You are working in many companies. There are people working in companies which are not from India. You might be working, for example, in a Brazilian company. Now, how do they send your salary to your bank account? How do they transfer money, let's say in HDFC, SBI? For that, the banks have to have a good relationship with them so that they can share common infrastructure. They can share common accounts so that the money transactions can be safe and smooth. And that is why the banks are increasingly opening up to open these kind of accounts with them. It might be slightly complicated in the initial time, but for the banks also, it's a win-win situation. Especially if you are a bank that is attracting more businesses, it will be a big situation for attracting importers and exporters specifically. Now, there is one more part of it called the Loro account. Loro account is something that usually does not remain in the news, but it's related to that only. So, when the domestic bank uses the account of a third party bank, that will be called as a Loro account. For example, let's take this example. SBI opened up an account in America. Let's say they opened up an account in a bank called Bank of America. Okay. Now, if this account has been opened up here, SBI will call it their Nostro account. Bank of America will call it their Vostro account. Now, let's say there's a third bank involved here as well. Let's say the Bank of Japan. What is it doing? Bank of Japan is also depositing money in this account so that they can also help their own traders. So, for example, the trader or the buyer has to deposit money here because they bought something from India. That buyer, their money is coming from Bank of Japan. So, for Bank of Japan, the same account will be called as a Noro account. Again, we are all talking about one single account only. We are not talking about multiple accounts. One single account will be known by different names, by different banks, depending upon how are you using that and depending upon what exactly is the relationship with that. So, if SBI has opened up an account in America, in a bank called Bank of America, for SBI, that's the Nostro account. For Bank of America, that is the Vostro account. And if there is one more bank involved, why is another bank involved? Because the person who wants to deposit money here, let's say that person takes a loan from Bank of Japan or that person has an account in Bank of Japan, when they would be the one who would be transferring money here or they would be the one doing transactions here for Bank of Japan, the same account will be called as a Noro account. This is how it works. These are not English terms, these are usually Latin terms that have been translated into our usage, but that is how it works. Now, if you have been able to understand that, amazing. If you have not been able to understand that, if you want some reassurance, the one reassurance I can give you is, so far we have not had a question on Nostro and Vostro asked in the UPSC prelims exam. But that doesn't mean that it cannot be asked. Just because it has not been asked so far, you can in fact say that it has a higher probability of being asked from now onwards because it has not been asked so far. But so far they are not asked. It's not a very difficult thing to understand. It basically helps importers and exporters get money very easily from the other country. Because if you are an exporter from India and you are selling stuff to some other country, how will you take money from them? They will say, I don't have an access to Indian bank, I don't do net banking transactions, I don't know how the taxes will be posted, so you tell me what to do. So it makes it easier. You can just tell them, go to your local bank, this bank, and this is the account number, deposit the money there. And that account will be held by, let's say, SBI. They will bring the money back to India for you. That is how it usually works. Now, RBI, as I said, this is in the news because RBI has given some directions for this. RBI has said that PNB will open up an account specifically for Government of India to deposit money there because we are buying pulses from Myanmar. So, RBI has given some instructions here. For example, RBI has said that settlement for trade transaction with any country, these banks, that is the authorized dealer banks in India where the account is being opened up, they may open special rupee Vostro account for corresponding banks and the partner trading countries. And again, these are commercial banks. They can be state cooperative banks also, urban cooperative banks also. They should be authorized by the RBI. So those banks authorized by the RBI can be scheduled commercial banks, can even be cooperative banks. They are the ones who have to open up the account. And again, please understand this once again, Vostro account is a local currency account because Vostro account means it is for PNB, it's a Vostro account. PNB is opening up that account for transferring money to Myanmar. So anyone who is depositing money in Vostro account, that will be local currency for PNB. So Vostro account is a local currency account. Nostro account on the other hand is a foreign currency account where you are getting money, the money is getting deposited in a foreign currency. Do understand and try and remember these nitty-gritties because these will be asked if the question is asked on these lines. Now, let's see if you are able to understand this. Again, read this carefully, pause on this screen, think about what the answer should be, lock in the answer in your mind and then play it once again. Okay, if you have decided what your answer should be, let's play. With reference to nostro vasto loro accounts, consider the following. First statement, a nostro account is a foreign currency account that a domestic bank holds in a foreign bank in the latter's currency. Right or wrong? Right. That is what we have been discussing. So if the PNB opens up an account in Bank of America, that will be the nostro account for PNB, where money will come in the form of dollar. So it will come in the form of foreign currency. So yes, it's a foreign currency account. Then, Vostro account is a rupee denominated account that a foreign bank holds in an Indian bank on behalf of its client. Yes, Vostro is thus the opposite of it. That is, if a foreigner or a foreign client opens up an account, let's say in Bank of India or PNB, whatever, for them it's a Vostro account. For us, it will be money will be coming in the form of rupee. So for us, Vostro account is a local currency denominated account. Third, a loro account refers to a third party account that a bank maintains on behalf of another correspondent bank, usually for trade settlement. This is what we discussed. When a third bank gets involved with the same account, they are not opening up the account, they are just trying to maintain the funds in it, they are trying to use it for trade settlement, means putting in the money, bringing the money out, for all of that. That becomes a loro account for the third party bank, that is a third bank. So again, this also is correct. All these three are correct. The answer is C. Again, these kind of questions can be asked slightly tricky, but they have a potential of being asked, especially when RBI gives a new kind of direction, especially when, you know, Myanmar has been a lot in the news in any ways because of the military coup, the rule of military ever since 2021 February. Myanmar has also been in the news because of the earthquake. So that also improves or increases the chances of these Myanmar related questions being asked. And because Vostro account and its regulation have been in the news because of Myanmar, that is why you should understand this. If you want, you can take a screenshot here. It's important. It will help you revise as well. Just take a screenshot, read it a couple of times, and you should be able to understand the distinction between nostro and the Vostro account. Okay. One more question. Again, I'll give you enough time. Read this carefully. Pause on this screen, maybe lock in your answer, and then you can play again and see what exactly will be the answer here. Got it? Perfect. You can play it again then. Consider the following implication in the context of trade settlement through Vostro account, especially under India's rupee trade mechanism. First, the use of Vostro account enables the countries under sanctions to continue bilateral trade with India without using SWIFT-based dollar payment. Yes, very important feature. That is why, as I told you, it was a lot in the news when India was buying oil from Russia. Because when we are buying oil from Russia, the problem is how do you pay money to the Russian banks? Russia has been under so many sanctions. SWIFT is a system of transaction used between banks internationally. So a bank from one country wants to transfer funds to the other country for its settlement, SWIFT system is used. Now, when you put sanctions on Russia, when the other countries don't agree to what the Russian banks are doing or are not accepting the settlements from Russian banks, you have to find a way out. That is when these accounts come in. So rather than actually going through an international system, the Russian bank will just open up an account in the Indian bank. Indian government will just pay the money in that account. That will be the Vostro account. So it allows you to circumvent the international transaction system, settlement system of SWIFT. Second, Vostro account based trade settlements require RBI's prior approval and are denominated in Indian rupee. Yes. Denominated in Indian rupee because again this is for the local currency. We just saw RBI was the one who has given this framework for the account for Myanmar specifically. So yes, their authorization, their approval is automatically required. Third, Vostro accounts held in India can be used to invest surplus balances in Indian government securities under RBI regulations. Yes, that is also correct. In the Vostro accounts, the money that you have, that the banks can use to invest in the government securities if it is within the RBI guidelines. So RBI gives guidelines how much money from this can be used in government securities so that the money increases or gives certain amount of interest. Then all transactions through WOSTO accounts are exempted from FEMA compliance since they are based on special arrangements. No. See, FEMA is a very strict law and you can't just have exceptions to this. FEMA is Foreign Exchange Management Act. It regulates how much foreign exchange is coming into the country, how much foreign exchange leaves the country. So if you give exemptions under that, that means you are actually improving the chances or giving a push to chances of black money, money laundering, etc. For the RBI to keep an eye on these kind of transactions, for example, the LRS scheme as we just discussed, the liberalized remittance scheme, all of this has to be FEMA compliant. So that is wrong because it has to be complied under FEMA. You can't have any exemptions to that. So the answer is 1, 2 and 3. A would be the correct answer here. A is the correct answer. I hope you got this one right. It's a long question. Long questions do take some time, but a lot of students, unfortunately, the moment they see a long question, they kind of get dissuaded from reading that question and they kind of think it's a difficult question. Don't do that. It's a pretty simple, straightforward question. Usually in most of the cases, if you don't know the answer, but in most of the cases when you have these kind of statements that a certain thing has been exempted from this, usually exemptions are very rare in India. Especially from the side of RBI, very rarely would you see that they have exempted certain account or they have exempted certain scheme from regulations. We are a country, fortunately or unfortunately, that do love their regulations. So exempting from regulations, again, if you know this for sure of right or wrong, you can mark your own. But if you don't know in these kind of statements, whether is it right, whether is it wrong, look for these kind of hints. As I told you earlier, extreme words are usually wrong, and these kind of hints also, when they say that something has been exempted or you don't have to do this in certain cases, that usually is wrong, that usually is the incorrect statement. If you want, you can take a screenshot here for revising for later on. It will help you in get up to the mark. This also brings us to the end of today's session, session number 4 it was. It is a pleasure to introduce all these concepts to you, and we have been trying to discuss these in as much detail as possible along with the practice questions to make sure that you are on track with your UPSC prelims preparation. If you have any other topic that you would want us to discuss in detail, feel free. The comment section is yours. Let us know if there is any specific topic you want us to cover, if there is any specific inclusion you would want. We would love to help you in any way possible. Also, do check out all the other courses that we are offering you at Narayana IAS Academy. Just check out the description of this video. You will find a link and you will get all that information here. Do stay tuned. I'll be coming back tomorrow for the 5th class, 12 p.m. where we will be discussing the remaining topics going ahead. Thank you so much for watching. Do hit the like and the subscribe button. My name is Harshmeet Singh. Bye-bye. Jai Hind.